Welcome options traders. I hope everybody had a fabulous Memorial Day weekend, and I just wanted to post this video answering the question, does active trading pay off? And this is a follow-up onto the Heiken Ashi candles video that I posted last week. And in that video, I tried to make the point why it's so important for investors to hang on to these trends. And I said that the Heiken Ashi candles would help you to identify those trends. But the reason it's important is that trends last longer than people expect. That's where the real money is made. And I said that people who try to get in and out of positions quickly end up spending a lot of commissions, and it just never pays off. But there will always be people who are going to argue that. So let's take a final look here and answer the question, does active trading pay off? First of all, let's take a look at the overall market. The market can be divided into two camps. We have passive investors, and passive investors are those who buy and hold a broad basket of stocks, such as the S&P 500, maybe the Russell 2000, but they're going to take the good with the bad, the ups and downs. They're not trying to time the market. They hold this basket of stocks, and if the market returns 12% at the end of the year, so be it. If it returns 15, that's fine. Whatever the market returns is what they take. That's passive investing. On the flip side, you're going to find people who are active investors, and there's a lot of active investors out there. Probably 70–80% of the mutual funds out there engage in some type of active investing. And active investors are people who, whether it's through technical analysis, economic data, through news, gut instinct, whatever, they're going to try and rebalance positions, buy, sell, get in, get out at different times in order to beat the overall market. So it should make sense that the market can be divided into two camps, passive plus active. There's no other place to be. You either hold the overall portfolio or you're doing some type of market timing. Just for the example, let's throw some numbers on here. Let's say that the market is made up of 30% passive investors and therefore 70% active. Now what I'm about to show you here is a little bit of a mathematical proof really that was published by William Sharpe in the Financial Analyst Journal, probably in about 1990, 91 sometime back in there. And so what we want to take a look at now is how these two camps are going to perform in the overall market. So let's just say for the entire market, 100% of the market, that it returns 12% for the year. Again, we can measure this according to the S&P 500, the Russell, all stocks in the universe, doesn't matter. But some measurement of the overall market returns 12%. Well, what else do we know? We know that passive investors, in this example is going to be 30%, must have also received 12%. Why? By definition, they are holding the broad-based market portfolio. That's exactly what they're getting, is what the market returns. But now comes the interesting question. What must the remaining 70% of the active traders receive? And this is where most active traders get off course and they say, oh, well, active trading, you're going to have to obviously make 15, 20, 30%. You're taking more risk, you're going to make more money. Not true. The remaining 70% of the active investors must also earn 12% on average. You can go through and work this out mathematically, but let me just show you an easier way to understand this intuitively because this throws people. How is it possible that the active investors must be earning the same rate of return? But take a look up top here. Let's say that you're, I don't know, back in school, back in college, and your overall grade needs to be a 90%. So for 100% of your tests, you need a 90. That's like saying 100% of the market. And so far, you've only taken 30% of your tests, and you have a 90% average so far. What does that tell you that you need for the remaining 70% of the tests? Well, obviously, it also has to be 90. Why? Because 30% plus 70% equals 100%. And if the 100% has to come up to 90, and 30% has come up to 90 so far, the remaining 70% must also be 90. It all has to balance. So looking down here below again, if the entire market returns 12% and 30% or whatever number you want to throw in there are passive investors, they must also receive 12%. But it also follows that the remaining 70% must receive that same return on average. So when we compare active versus passive investors, active traders on average earn the same returns as passive investors. Active traders, however, pay far greater commissions, so the returns must be lower on average. Now you're probably thinking, well, what about this phrase here, on average? Does it mean that some active traders can beat the market? And the answer is yes, some. Some may have overweighted their portfolio. So for example, recently the place to be was in the FANG stocks, the Facebook, Amazons, Netflix, and Googles. And so for every trader that overweighted their portfolio relative to the S&P 500, yes, they would have beaten the overall market. But it also means that for everyone who beat the market, another must have lost. And it must have been another active trader. Why? They're the only ones trading among other active investors. Remember, the passive investors are not trading. They're just buying and holding. So if somebody buys Facebook, Amazon, Netflix, Google, or whatever is the hot stock for that year, it means that somebody else must have sold them those shares, another active investor, and therefore missed out on those returns. Or maybe they went short those shares and actually took losses. But for every trader that beats the market, there must be one that also lost. And that's because 100% of the shares must be owned by someone. And they cannot all be above average. For every winner, there has to be a loser. But there's an even bigger problem when it comes to market timing. Successful market timing requires you to be correct not once, but twice. So for example, if you sell shares of stock at 100, and let's say you watch it fall to 95, yeah, you're going to feel pretty successful. But what if it's trading for 120 the following week? Suddenly the timing didn't seem like it was so hot. It certainly didn't pay off. So to make it pay off in this example, you had to get out at 100, but you had to get back in around 95. And so for one more little mathematical curiosity here, if you have a 70% chance of being correct at tops and bottoms, which nobody does, that's being unbelievably overgenerous in the probabilities. But even if you did, to be correct twice, you'd only be correct 49% of the time, 70% on the way out, 70% on the way down, not even as good as a coin flip. So to make timing successful, you have to be correct twice, and that complicates things. So when it comes to options, options are a zero-sum game. Take a look at this green profile here, a $50 call. That's a long call, and we're going to look at it compared to the short call in red. So notice that if the long call holder profits, let's say if the stock is 75, the short call holder must have lost exactly the same amount. If the stock falls down here to 45, the short call holder, in this example, makes 10, but the long call holder lost 10. Now again, it doesn't matter. It doesn't mean that you had to be the one holding the entire loss. Maybe you paid 10 for this option, you sold it for a $3 loss, sold it to somebody else, that person took a $7 loss. But in the aggregate, in the entire market, the gainers must offset the losers. And that's because options are a zero-sum game. So when you see people who are trading options and telling you to get in and get out, you are generating tremendous amounts of commissions. And in relative terms, option commissions are very expensive. Yeah, they might seem like they're only $5, $6, $7, but if the option's only going to be $200 or $300 to buy, it's a very big percentage, certainly far bigger than it is for shares of stock. And that makes things far more difficult. And then on top of it, you have to be correct to get in and to get out, and you have to beat the overall market, which means you have to be better than average consistently. And that is something that is not going to happen year after year. Can you do it in the short run? Of course. Lots of people are going to day trade and be in and out of positions, and they're going to make money. And it gives you the illusion that it works. But if you keep doing it, you're going to find out that these averages must work out. But instead, what if you could do this? What if you could take that long call, here's a long $50 call, and as the stock moves in your favor, you roll it. And over time, we shift it above zero. Now I can't lose. You can see here's my zero line right here, and I've got this guaranteed gain, but I still have the ability to make unlimited gains. That's the benefit of rolling, but it gets even better. Maybe I'm more concerned that the stock price is going to fall, but I'd also like to hold out for maybe some more upside. Well, maybe I could leg into a vertical spread, and I can shift from the green to this blue. Yes, I've capped my upside, but I've also guaranteed a much higher minimum, and I can also make some money through this range through here. What if I don't like the idea of being fully capped above 65 here? Well, I can change again. Maybe I can go into a back spread. I can reduce my profits out here on the left side in exchange for adding some deltas out here. But the point is, there are just countless strategies where I can hedge, roll, morph, which is what these are some examples of, where I stay in the position, but I'm continually shifting that profit and loss curve higher and higher on that graph, which means I'm continually locking in profits, but I'm staying on the trend. So the long-term trends are where the money is made, and if you're getting in and getting out, you are missing those trends, and you're spending a lot of commissions for no gains. Instead, take the time to learn option strategies so you can stay in these positions for much longer periods of time and capture those valuable long-term trends. For those who'd like to learn more about the art and science of options trading, please join us on the Facebook group optionsato z.com.